Hello and welcome to IG's Trading the Markets podcast. Now, today we're here to talk about trading options with some strategies provided by my guest, Serge Berger from thesteadytrader.com, who joins us from Zurich. Serge, great to chat to you as always. I wanted to start by talking about the put-call ratio, because I know you look at this ratio quite a lot, and just as a bit of an educational piece for our listeners and viewers, because a lot of people outside of options use this kind of as to get a sense of the bullish or bearishness in the market. So can you just tell us a bit about what's been happening with the ratio lately and also what actually it can tell us?
Sure. Hey, Victoria. Yeah, I mean, it's an interesting ratio to watch. And as always, I'll just quickly say, if that's the only thing you're watching, it's not going to be that helpful. But if you use it in context with other things, I think it's always a good thing. But at its most simplistic part, and I have the put call ratio up here on the screen now. What we're looking at here, there's different ones. There's ones for only focusing on the S&P 500. I've got the one here that's on the CBOE, this equity put call ratio. And essentially what it tells you is how many puts versus how many calls are being traded. So what we saw over the past few weeks is a complete collapse of this ratio, meaning the numerator essentially collapsed. So much less puts were being traded than calls, meaning people were basically speculating and buying a lot of upside calls. And a lot of times when you see that, it's a sort of a leading contra indicator, because it basically means that people are being too bullish. So when you see it completely collapsing like this, when it's just the absence of put buyers, it's usually, or oftentimes I should say, a pretty good sign that we're going to see equities correct to some extent.
Okay, so talk to us a bit about what you've been seeing in terms of volatility lately, because I mean, we've seen vols get pretty much crushed following sort of the Fed's unlimited pledge to QE, supporting the markets, which has gone hand in hand with the rise we've seen in equities. But obviously, this week has been a little bit different. We've had that major sell-off on Thursday in US stocks.
It's actually very interesting what's been happening, and I'm going to just bring up the chart of the VIX here as it was about at this point about 24 hours ago or so. So before the big sell-off on Thursday, June 11th. And what you can see here, this is just purely the VIX. Again, this is the implied volatility, the S&P 500, and you can see that the implied volatility, the VIX, actually rallied about 20% into the Fed meeting. So while stocks were just whistling right past the graveyard, so to speak, the put buyers, protection buyers, started to come into the market. And not to overly simplify this, and this is also literally the phrase that I used for my clients yesterday, I put a 21-day moving average on this chart. That's the yellow line, and it has a fairly decent sort of track record of when you break above it and kind of gap above it, you tend to see a spike in volatility. Usually that means a correction in stocks, and if you break below it, you start to see stocks rally, as happened basically there in the second half of March. So, I think we're probably in a regime right now where we could see the VIX. My best case would be somewhere in on the very low end, the low 20s, excuse me, the mid 20s, but maybe more like the high 20s to maybe low 40s kind of is what I would imagine for right now.
Okay, give us some insight into your trade idea on the S&P using options, and if you could just explain the strategy and kind of give an idea of the reasons behind the strategy as well.
Sure. Well, maybe to give some context, I'm going to just quickly bring up the chart of the actual S&P 500 itself, and this is going to be a longer term chart, just so we can kind of contextualize, and then we can look at the trade idea. So this is your sort of 10 whatever plus year trend within those two yellow parallels, and you can see we broke above it, i.e. breakout, fake out January, February, then broke below it in March, and now we're right back to really what is the true sort of average resistance point. So that's just to give you an idea where we are. We have so far also put in a bearish reversal week with one trading day left in the on the week. So I think for right now, this looks to me like we might be having a top in the market here, and I'm going to use the SPY ETF, which represents the S&P 500, as the tool we want to do the options trade on. And so we had what's called an island reversal from a technical perspective, which means we gapped higher in stocks on the S&P on June 5th. We gapped lower on June 11th. So this has this sort of island, these few days trading up here, kind of isolated, and usually, or a lot of times, that offers us a good level to trade against on the short side. So there's two ways that I like to do these things, with a vertical debit spread or a vertical credit spread. And I'll go through what these two things essentially mean. A debit spread is where you buy a put in this case, and then you sell a lowest strike put against it for protection, and you're paying money for the trade. So the benefit of it is that if you get it right, you will make a bit more money than if you do a credit spread, which I'll talk about in a minute. So what I think right now makes sense is to give yourself both time and space. The time factor here may be being more important. So instead of using front month, June, or even July options, I'm going to use August options, largely for protection, because if we use August options and something the trade goes against us, then we have a bit more, we're a bit more hedged, actually a lot more hedged than if you use short dated options. So very specifically, I think it makes sense to buy the August 300 strike put and sell against that the 290 strike put. And all of that should be costing you a net debit, so you'd be paying money for it, but it's still a lot cheaper than shorting the stock, if you will. And you don't have volatility being as big a factor, implied volatility. So it's a nice thing in that sense. The other thing would be a credit spread, which is really what I do for the most part, both on the research side for the steadytrader.com and for our investment advisory company. And so the bet here is a different one, whereas with the credit spread, we're not saying it has to go lower. All we're saying is that we don't think that the SPY is going to go above 330. In other words, with this credit spread, and I'll outline in a minute, we'll make money whether the S&P goes lower, sideways, or from these current levels, it could even go against us like 7 or 8%. Now, specifically what I'd like to do is I'd like to sell the 330 strike August call, and these are the monthly options, and buy against at the 335 strike call. So sell the 330 strike call, buy the 335 for a net credit. So you actually get money deposited into your broker account for doing this trade. Whereas in the debit spread, you have to pay money. So with this credit spread, the great thing is, again, A, you get money into, you actually receive money, and B, you can be totally wrong in the stock. It can go against you to a degree, and you can still make money. So those are the two ideas that I have here on the SPY.
All right, and talk us through your trade idea on Apple now.
Apple, again, just to give you some visuals here. If you look at Apple on the weekly chart, you can see the long-term trend here. We had within those two yellow lines, and then we went vertical. We've reached the upper end of even this increasingly steep channel. So I think the stock is basically very overbought. On the shorter-term time frame on the daily chart, if you look at Apple, it has that 21-day moving average, like I showed you before in the VIX, and it's actually one of the few very large stocks that hasn't yet reached that 21-day moving average. So I think the bet for right now for me is for it to go at least down there and potentially lower over maybe the next few weeks or something like that. So to look at the debit spread first, again, that's where we pay money to get into the trade. I think here again using August options, and we want to buy the 340 strike put and sell against at the 320 strike put. And again, it's going to cost us a debit to get into that trade. And on average, we don't want to hold any of these trades, even the SPY, longer than, say, 3 weeks, because otherwise the trade gets riskier from a time decay perspective. Alternatively, if you want to do a credit spread, which again is for the most part what we tend to do, you could sell a 380 strike call, so way up here on Apple, and then buy against at a 385 strike call. So you do, again, let's call it a bear call spread, which again would allow you to make money in this case, whether the stock goes sideways, lower, or even all the way up to 380. So it gives you a much larger buffer.
All right, Serge, thank you so much for your insights as always.
Thank you.
That was Serge Berger from thesteadytrader.com joining us down the line from Zurich to talk through his options trading strategies. I'm Victoria Scholar, and thank you so much for watching IGTV.
For more videos like these, subscribe to our YouTube channel, IG UK, and make sure to follow us on Twitter. We're at IGTV.